2025, with prices shifting and buyer behaviour changing, should you be investing in flats or houses? Hi, and welcome back to James Talks Property. If you're new here, my name's James, and this channel is all about helping you build and grow your knowledge about property investing without gimmicks or unrealistic promises. I'm the co-founder and managing director of a property investment business called Freehold Property Partners, but this channel is all about helping you. If you like the content, don't forget to hit like and subscribe to the channel. Like I mentioned, today's video is all about helping you understand whether you should be investing in flats or houses in 2025. We'll discuss the pros and cons of both, what's happened historically, as well as the opportunity moving forward. In my business, I speak to property investors all day, every day. And the first thing a lot of property investors think about when they're comparing flats versus houses is the argument with leasehold versus freehold and the service charge involved in a leasehold property. The reason for this is flats are typically leasehold properties. You'll own the flat, but you don't own the land in which the flat is built on. The freeholder owns that. In older properties, this can mean that you have to pay for things like ground rent, service charge, and maintenance costs. And in newer properties, it's mainly the service charge because ground rent is no longer a thing that you have to be aware of in terms of costs in newer properties. And to contrast this, houses are almost always freehold properties. The only time you really get leasehold houses is when there's a ghost freeholder, and that essentially means that somebody somewhere owns the land where the property's been built on, but nobody knows who it is and nobody can find the owner of the land. I understand the concerns around leasehold properties because previously leasehold could have and has caused some headaches and issues for property investors. This is because historically you'd have to pay for things like ground rent that could double every 10 years and service charge which could spiral out of control. Having said that, if you're buying a newer property and you've done your due diligence, the chances are these issues won't be such a headache. As a property investor, the chances are you're going to buy both properties. So if and when you're looking at leasehold properties or looking at flats in particular, you just need to make sure that you can be confident that the service charge isn't going to spiral. This might mean that you're not buying properties that come with swimming pools and all the different amenities. You might get something that is in demand in an area of high demand, but also doesn't have too many bells and whistles. The way I look at it is leasehold is only really paying for things in advance for when things go wrong. The block manager can't just charge you a service charge to make profit. They have to demonstrate what that money has been spent on, and if they don't spend all the money on the services of the building, they obviously won't put the service charge up. Having said that, the rules were a little bit more loose a few years ago, which is why some people have a bad taste in their mouth about leasehold properties. Second thing you need to be aware of when comparing flats to houses is the maintenance and management of the property. Because flats are shared buildings, you usually have less maintenance and management requirements on this type of property, where you're not specifically responsible for the structure of the property, the roof, and so on and so forth. This is obviously different with houses. If you own a house and there's something that goes wrong with the roof, something goes wrong with the structure of the property, you're liable, you need to be able to pay for that, so that's something that you'll need to be aware of. This is why when I'm working with clients that are looking for houses rather than flats, we're getting good quality new properties that come with a 10-year build warranty, so you're not then liable for the structure of the property. The other thing you'll want to be aware of is obviously the garden. When you're buying a property to rent out to a tenant, a garden is often desirable for renters like young families. Having said that, you don't necessarily want to have a property that has a big garden because of the upkeep on the property, and obviously you may need to pay for things when that tenant moves out. But it's ultimately up to you. As you scale a portfolio, you're going to buy both types of properties, but you just need to target the right properties and make sure that they go back to your original goals with building the portfolio. Having said that, if you're investing remotely and you're not located in the vicinity of the property, flats can often be less of a headache than houses, especially if you're looking at new properties rather than properties that have been there for a significant amount of time. Because if we're looking at older flats, then obviously we have things like cladding issues that have been a problem over the last few years, as well as things like the ground rent. So essentially, you're comparing convenience with control. Are you more interested in convenience, or are you more interested in having full control over the property and what you do with it? As always, when we're investing in property, it needs to always come back to our initial goal and what we're working towards. This might mean that you're looking for capital appreciation, so you think that houses are going to appreciate more, so you target that type of property. And if we look historically, houses on the whole have grown more than what flats have in terms of capital growth. Having said that, that's just if you take the average property across the country. It's not targeting areas for capital growth, so it's not necessarily as straightforward as what it might seem like. For example, if you bought a house in London 5 years ago, the chances are you've probably not seen that much capital growth in that time frame. And if we look at the actual data, property prices in London haven't really grown much since 2016. What you could have done instead is taken that pot of cash and bought a prime city centre flat in the city centre of Manchester, and that property would have grown significantly in the last 5 years. So what we need to do is we need to make sure we're not just buying locally or just buying for convenience or something that feels safe. We need to target properties that are going to grow in value because of strong fundamentals, and you're going to have the opportunity to build your wealth through the appreciation. It essentially means that the location is probably more important than the property type. If you bought a house in Greater Manchester at the same time as you bought a flat, the chances are you probably would have seen very similar appreciation in that time frame. It all comes back to the demand of the area, the quality of the property, and making sure you have the fundamentals in place in anywhere in which you're investing. In 2025, the outlook is a little bit different to what it may have been 5, 10, or even 15 years ago. And the main reason for that is affordability. With interest rates and affordability tests changing, a lot of purchasers, especially first-time buyers, won't have the opportunity to buy big houses. This means that we're more likely to see strong capital growth on properties like terraced houses, semi-detached, as well as some flats. This is because as property prices continue to increase, it prices out people out of the market, which means demand drops for that type of property, and the appreciation of that type of property isn't quite as strong as others. So if you're in a position where you could purchase good quality flats in areas of high demand in a well-managed building, the chances are you could get into a good quality opportunity and see some strong appreciation as well as a good rental return. So in 2025, we're probably less in a position where we're comparing flats to houses. We're probably in a position where we're more targeting specific areas, and then we're working out what the demand is for that specific area in terms of property type. And if you do go for flats, you need to make sure it's a quality flat in the right area where you're going to rent it out easily. If you already have a portfolio and you're just looking to diversify, this will give you the opportunity to get into a few different areas and consider some different types of properties. Houses still offer greater long-term flexibility and the opportunity to build your wealth, but you need to make sure that if you're buying houses in an area where it's still affordable for the local market to purchase them. So remember, property investment isn't one size fits all. The chances are at some point you're going to scale and you're going to have both types of properties, but you need to make sure that demand is for the type of property in which you're purchasing in an area where you have the best opportunity for capital growth. All of my clients will purchase both houses and flats at one time or another, but it needs to work for your budget and it needs to also come back to your original goals. So let me know if you're team houses or flats in the current market, and I'll see you in the next one.